Imagine turning on the news and hearing that the world has only a few 100 million ounces of silver left in accessible, above-ground inventories. Not billions, not trillions, a few 100 million. And that number is dropping every single day. That is not a prediction. That is the math behind one of the most underreported resource crises of our time. The silver market is bleeding inventory, and most people have no idea how close we are to a breaking point. Welcome back to Macro Truth. Today we are doing something a little different. We are going to sit down and walk through the real numbers, the supply and demand tables, the mining reports, the industrial consumption data, and the vault records to answer one simple question. How much silver is actually left, and what happens when it runs out? Before we dive in, take a second to hit that like button and subscribe to Macro Truth. Trust me, by the time you finish this video, you will understand why staying informed on this topic could be one of the most important things you do this year. And do not worry, we are not going to throw a bunch of complicated charts at you. Instead, we are going to tell a story about a metal that powers your phone, your car, your solar panels, and the entire global green energy revolution. A metal that is disappearing faster than almost anyone realizes. So get comfortable, because this is going to take about 50 minutes, and by the end, you will see silver in a completely different light. Let us start with the headline number. According to the most recent data from the Silver Institute, the Thomson Reuters GFMS survey, and various exchange reports, the total amount of silver held in identifiable, investable above-ground inventories is now estimated to be somewhere in the range of 400 to 450 million ounces. That sounds like a lot, does it not? 400 million ounces. But let us put that in perspective. Global silver mining produces roughly 850 million ounces per year. That means the total remaining above-ground inventory is less than 6 months of global mine supply. And here is the kicker. That inventory is not all available for delivery. A huge chunk of it is tied up in exchange-traded products, in central bank reserves, in strategic stockpiles for industrial users, and in the vaults of bullion banks that are required to hold certain amounts for their derivatives contracts. The truly free, unencumbered silver that can be bought and delivered tomorrow? That number is much, much smaller. Some analysts put it as low as 100 to 150 million ounces, but we will get to that. First, we need to understand how we got here. Rewind the clock 20 years. The silver market was swimming in metal. Decades of mining, recycling, and above-ground hoarding had created a massive surplus. The price was low, often below $5 an ounce. Industrial demand was steady, but not explosive. And most investors saw silver as gold's poorer cousin, a volatile metal with no real story. Then, two things changed. First, the rise of consumer electronics. Every smartphone, every laptop, every tablet, every flat-screen TV uses silver. Not a lot per device, but when you multiply billions of devices, it adds up fast. Second, and more importantly, the green energy revolution. Solar panels are silver-intensive. Each photovoltaic cell requires a layer of silver paste to conduct electricity. A typical 60-cell solar panel uses about 2/3 of an ounce of silver. Multiply that by the hundreds of millions of panels installed every year, and you start to see the problem. By the early 2020s, industrial demand for silver had grown to more than 50% of total annual supply. And that is not even counting investment demand, jewelry or silverware. Now here's the part that most people miss. Mining supply does not respond quickly to price increases. It takes 5 to 10 years to discover a new silver deposit, get permits, raise capital, and build a mine. Even if the price tripled tomorrow, you would not see a single new ounce of mined silver for at least half a decade. Meanwhile, recycling of silver from old electronics and industrial scrap has plateaued because the easy sources have already been tapped. So we have a situation where demand is growing at 3 to 5% per year, driven largely by solar and electric vehicles, while mine supply is basically flat. The result? A structural deficit. In 2021, the silver deficit was about 50 million ounces. In 2022, it grew to 80 million. In 2023, it hit 140 million. And preliminary data for 2024 suggests the deficit could be even larger, possibly 180 to 200 million ounces. That means every year we are consuming 100 to 200 million more ounces of silver than we are mining. And where does that extra silver come from? It comes from the above-ground inventories. Let us do the math together. Starting in 2021, we had roughly 800 million ounces of above-ground investable silver. That was the peak of the post-financial crisis stockpile. Over the next 3 years, cumulative deficits of, let us say, 50 plus 80 plus 140 equals 270 million ounces. That would bring the inventory down to 530 million. Then 2024 adds another 180 million deficit, bringing us down to 350 million. That is already dangerously low. But remember, those deficits are based on official numbers that many analysts believe are too conservative. Some independent researchers argue that the real deficits have been much larger because of unreported industrial consumption and aggressive leasing of silver by bullion banks. If we use their numbers, we could already be below 200 million ounces of truly available silver. And that brings us to the most important question. What is the minimum amount of silver that must be held in inventories to keep the market functioning? This is what commodity traders call the operating inventory or the pipeline inventory. Refineries, mints, electronics manufacturers, and jewelry producers all need a certain amount of silver on hand to keep their production lines running. If that pipeline runs dry, you get delivery defaults, contract cancellations, and price spikes that make the 1980 Hunt Brothers silver squeeze look like a picnic. The London Bullion Market Association, or LBMA, which is the largest wholesale silver market in the world, publishes a monthly report on the amount of silver held in their vaults. As of the most recent data, the LBMA vaults hold approximately 900 million ounces of silver. That sounds enormous, right? But here's the catch. Almost all of that silver is already owned by somebody. It is not available for sale. It is held by banks, funds, and industrial users as working inventory. The amount that is actually available for delivery on any given day is a tiny fraction. During the silver squeeze of early 2021, the LBMA reported that the number of ounces eligible for delivery had fallen to less than 50 million. That is less than 3 days of global industrial consumption. And that was 3 years ago. Since then, the deficits have only gotten worse. Now let us talk about the COMEX, the main commodity exchange for silver in the United States. The COMEX publishes a weekly report showing the amount of silver held in their registered warehouses. Registered silver is the stuff that is available to satisfy delivery demands on futures contracts. A few years ago, registered COMEX silver was consistently above 100 million ounces. As of the latest reports, it has dropped to around 30 to 40 million ounces, and that is not a typo. The largest silver exchange in the world, the place where the entire global futures market looks for price discovery, has barely a month's worth of industrial demand sitting in its registered vaults. Now, you might be thinking, but macro truth, the price of silver is not skyrocketing. If inventories are that low, why is silver still trading at $20-something an ounce? That is an excellent question, and it gets to the heart of the disconnect between the physical market and the paper market. You see, for every physical ounce of silver that exists, there are dozens, maybe hundreds of paper claims on that ounce. Futures contracts, options, unallocated pool accounts, exchange-traded funds that allow fractional ownership, and leveraged derivative products. These paper contracts are settled in cash most of the time, not in physical metal. So the price of silver is largely determined by trading in these paper markets, where traders are betting on price movements, not demanding delivery of bars. But every once in a while, the physical market asserts itself. When enough people say, no, I do not want your cash, I want the actual metal, the system gets strained. That is what happened in early 2021 when Reddit traders and retail investors piled into silver, and the COMEX saw delivery requests spike. The price did shoot up to $30, but then it fell back because the big banks and hedge funds had enough paper ammunition to push it down again. The question is, how many more times can they do that before the physical metal runs out? Let us look at the demand side in more detail. The fastest growing source of silver demand is photovoltaics, meaning solar panels. In 2020, the solar industry consumed about 80 million ounces of silver. By 2023, that number had grown to 140 million ounces. By 2025, projections are for 200 million ounces. And by 2030, if the world meets its climate goals, solar alone could consume 400 million ounces per year. That is half of the entire current annual mine production, just for solar panels. Then you have electric vehicles. An internal combustion car uses about 1 ounce of silver for electronics and switches. An electric vehicle uses 3 to 5 ounces, not including the charging infrastructure. In 2023, about 10 million EVs were sold globally. That is roughly 40 million ounces of silver. By 2027, EV sales are expected to exceed 20 million units, consuming 80 million ounces. Then there's 5G telecommunications, data centers, artificial intelligence hardware, and all the other electronics that make modern life possible. Every new generation of technology uses more silver, not less, because silver is the most electrically conductive metal on Earth. There is no substitute. Copper is cheaper, but less conductive. Aluminum is even cheaper, but much less efficient. For high-frequency, high-performance applications, silver is the only choice. Now consider the supply side. Global silver mining production peaked in 2016 at around 900 million ounces. Since then, it has been slowly declining. Why? Because the easy, high-grade silver deposits have been mined out. The average grade of silver ore has fallen by more than 30% over the past 20 years. That means miners have to move more rock to get the same amount of silver, which increases costs. At the same time, Environmental regulations, labor costs, and energy prices have all gone up. Many silver mines are actually byproduct mines, meaning they produce silver while primarily mining zinc, lead, copper, or gold. When those primary metals drop in price, it becomes uneconomical to keep the mine open, even if silver prices are high. So there is a hard limit on how fast silver production can grow. The world's largest silver miners, such as Fresnillo, Polymetal, Pan American Silver, and Southern Copper, have all reported declining production or flat guidance for the next few years. New projects are few and far between. The permitting process for a new mine in the United States, Canada, or Australia takes 7 to 10 years on average. In Latin America, where most of the world's silver is mined, political instability and resource nationalism have made it even harder to develop new deposits. There is one more source of supply that we have not talked about yet, and that is government stockpiles. The United States government used to hold billions of ounces of silver as a strategic reserve. Most of that was sold off in the 1980s and 1990s. Today, the U.S. strategic silver stockpile is effectively zero. China is known to hold a large silver reserve, but nobody outside the Chinese government knows exactly how much. Some analysts estimate it at several 100 million ounces. But China is also the world's largest consumer of silver for industrial purposes, so it is unlikely they will release those reserves anytime soon. India holds some silver as well, but again, most of it is in private hands or in religious institutions. The point is, there is no massive government stockpile waiting to be dumped on the market. The only silver left is either already spoken for, or it is in the hands of investors who are holding it for the long term. So let us update our math. Starting inventory of investable above-ground silver in 2021, let us say 800 million ounces. Cumulative deficits from 2021 through 2024, let us use the Silver Institute numbers of 50, 80, 140, and 180 million respectively. That totals 450 million ounces of deficit. 800 minus 450 leaves 350 million ounces. But that is the total inventorable silver, meaning all the bars, coins, and rounds held by exchanges, funds, and large vaults. Now, subtract the minimum operating inventory. What is the minimum? The LBMA itself has said that its vaults need to maintain at least 150 million ounces for its member banks to conduct daily business without stress. The COMEX needs at least 30 million. Industrial users hold maybe another 50 million as safety stock. And then there are the physical silver ETFs like SLV and PSLV, which hold about 300 million ounces combined. But that ETF silver is not available for industrial use. It is owned by retail and institutional investors who have bought shares. Those shares can be redeemed for physical silver, but only if the fund manager allows it, and there are limits. So the truly free silver, the silver that is not already encumbered by a legal claim, might be only the difference between the total inventory and all of these committed holdings. That difference is getting very, very small. Some market insiders believe that the amount of silver available for immediate delivery at current prices is less than 50 million ounces, and that is global. Now let us talk about what happens when that number approaches zero. In a normal commodity market, when inventories fall below a critical threshold, the price rises until demand decreases or supply increases. But silver is not a normal commodity. It is both an industrial metal and a monetary metal. That means it has two completely different demand drivers. Industrial buyers need silver to make products. They have to have it. If the price goes up, they might try to use less, but as we said, there's no substitute in many high-tech applications. So industrial demand is relatively inelastic. Meanwhile, investment demand can explode when people start to fear that the physical market is breaking. That is exactly what happened in the late 1970s when the Hunt brothers tried to corner the silver market. At that time, the price went from under $5 to over $50 in a matter of months. But that was a speculative corner, a deliberate attempt to buy up all the available metal. Today, we have a different situation. We have a structural deficit driven by real industrial consumption. That is much more sustainable and much more dangerous for anyone who is short silver. Think of it this way. Every year, the world needs to produce or recycle about 1 billion ounces of silver to meet all demand. Mining produces 850 million. Recycling adds about 150 million. That gets you to 1 billion, roughly in balance. But we are seeing deficits because recycling is actually declining as the stock of old electronics gets harder to collect and process, and because demand is growing faster than anyone predicted. So we are eating into inventory. At the current rate of deficit, somewhere between 150 and 200 million ounces per year, we will completely exhaust the remaining 350 million ounces of above-ground inventory in less than 2 years. That is assuming the deficits do not get worse. But they will get worse because solar panel installations are accelerating, EV adoption is accelerating, and data center construction is exploding due to AI. So we are looking at a timeline of maybe 12 to 18 months before the visible inventories hit rock bottom. What does rock bottom look like? It does not mean the world runs out of silver. There is still plenty of silver in the ground. But it means that the above ground metal that is not already owned by someone who wants to keep it will be gone. At that point, the only way to get silver for industrial use will be to buy it from existing holders at whatever price they demand. And those holders, especially retail investors who have been stacking physical coins and bars, are not going to sell for $25 an ounce. They are going to hold for much higher prices. So the price would have to rise to a level that neither forces industrial users to cut consumption drastically, or that brings a huge wave of scrap and recycling into the market, or that makes it economically viable to reopen old mines and develop new ones extremely quickly. None of those things can happen overnight. In the meantime, the paper markets will face a crisis of confidence. If a futures contract calls for delivery of physical silver and the seller cannot produce the metal, that is a default. If a bank holds unallocated silver accounts and too many customers demand to take physical delivery, that bank might be forced to suspend withdrawals or go bankrupt. If an ETF cannot issue new shares because there is no silver to back them, the share price could decouple from the spot price. These are not hypothetical scenarios. They have happened in other commodities. The London Metal Exchange nickel crisis in 2022 is a perfect example. The price of nickel doubled in 24 hours because the physical market could not deliver against short positions. The exchange had to cancel trades and halt trading for days. That was for nickel, a metal with much larger inventories than silver. Imagine what happens when the trigger is pulled on silver. Now, you might be wondering, why is no one talking about this? Why are the mainstream financial news networks not covering the silver deficit? Part of the answer is that silver is a niche market. It is not as big as oil, copper, or even gold in terms of dollar value. Part of the answer is that the big banks and bullion dealers have a vested interest in keeping the price contained. They are short silver in the futures market. They sell contracts that promise to deliver silver at a future date, and then they hedge by holding some physical metal and by buying other paper contracts. If the price spikes, they could face billions in losses. So they use their influence and their deep pockets to keep the price from breaking out. They do this by aggressively short selling on the COMEX whenever the price starts to rise. And they have the capital to do it because they are backed by the largest financial institutions in the world. But every time they short silver, they are increasing their exposure. They are selling more promises than they have metal to back. Eventually, that pyramid collapses. There's another reason the mainstream is quiet about silver. The narrative is that we are transitioning to a green economy, and that transition requires metals. But the focus has been on lithium, cobalt, copper, and rare earths. Silver gets less attention because it is perceived as a precious metal, something for investors and speculators, not a critical industrial commodity. That perception is wrong, and it is changing, but change is slow. In the meantime, those who are paying attention are quietly accumulating physical silver. Not paper silver, not futures contracts, not ETFs, but actual coins and bars that they hold in their own possession. They are doing this because they understand the math. They see the deficits, they watch the COMEX registered inventory numbers every week. They read the mining reports and the industrial demand forecasts, and they have come to the same conclusion that Macro Truth is sharing with you today. The silver market is heading for a historic dislocation. The only question is exactly when and how violently. Let us walk through a few scenarios. Scenario 1 is the gradual adjustment. Silver prices slowly rise from the current $25 per ounce to $30, then $35, then $40 over a period of 2 or 3 years. Industrial users cut back where they can, substituting copper or aluminum in less critical applications. Recycling increases because higher prices make it worth the effort to reclaim silver from old circuit boards and catalytic converters. Mining companies accelerate new projects, and a few new mines come online by 2028. The deficits shrink but do not disappear. Inventories stabilize at a very low level, and the market learns to live with tight supplies. This is the optimistic scenario, and it assumes that nothing unexpected happens. No supply shocks, no demand spikes, no financial panic. Scenario 2 is the squeeze. In this scenario, the current deficits continue for another 18 months, depleting visible inventories to near zero. A major industrial buyer, perhaps a solar panel manufacturer or an automaker, finds that it cannot secure enough silver for its production schedule. It goes to the futures market and demands delivery. The COMEX registered inventory is only a few million ounces at that point. The few owners of physical silver see what is happening and refuse to sell at any reasonable price. The price spikes to $50, then $60, then $100 per ounce in a matter of weeks. The exchange halts trading. Some brokerages and banks that were short silver go bankrupt. There's a cascade of margin calls and defaults. The U.S. Commodity Futures Trading Commission investigates, but the damage is done. Trust in the paper silver market is shattered. Investors who had been holding unallocated accounts rushed to take physical delivery, but the banks have no metal to give. Lawsuits follow. The price of physical silver diverges completely from the paper price. Physical coins and bars trade at huge premiums over the futures price. This scenario is not far-fetched. It is exactly what happened in the nickel market in 2022, and silver is a much smaller market with much lower inventories. Scenario 3 is the monetary awakening. In this scenario, something else happens first. A financial crisis, a currency crisis, a war, or a loss of confidence in the US dollar. Investors around the world rush into gold and silver as safe havens. Silver, being cheaper and more accessible, sees an even larger percentage increase than gold. The gold to silver ratio, which currently sits around 85 to 1, meaning 85 ounces of silver by 1 ounce of gold, collapses to its historical average of about 15 to 1. That would imply a silver price of over $130 per ounce if gold is at $2,000. But if gold also goes up in a crisis, silver could go much higher. In this scenario, investment demand adds hundreds of millions of ounces of demand on top of industrial demand. The deficits become astronomical. The remaining above-ground silver is bought up in months, not years, and the price goes into what traders call a melt-up. No one knows where it stops, but some analysts have talked about $200, $300, even $500 per ounce. That sounds crazy, but remember, silver was once used as currency. A Roman soldier's monthly wage was a few silver coins. In today's terms, that silver would be worth thousands of dollars. So it is not that silver is expensive. It is that our paper money has been devalued so much that it takes a mountain of dollars to buy a single ounce of silver. Which scenario is most likely? Macro Truth does not have a crystal ball. But if you look at the numbers, the deficits are not going away. Solar panel production is ramping up faster than almost any forecast from 5 years ago. Electric vehicle adoption is happening faster than expected. And the mining industry is not showing any signs of a major production increase in the next 3 to 5 years. The only wild card is recycling. If someone invents a cheap, efficient way to recover silver from all the e-waste piling up in landfills, that could add tens of millions of ounces per year. But that technology does not exist at scale yet. And even if it did, the energy cost and environmental regulations would make it challenging. So the most realistic expectation is that deficits continue for at least the next 3 to 5 years. That means inventories will continue to fall. At some point, the market will break. It might be a small break, like a temporary spike to $40 or $50 that brings in enough scrap to calm things down. Or it might be a massive break, like scenario 2 or 3. But the direction is clear. The inventory is going down, the demand is going up, and there is no magic switch to create more silver. Now, what does this mean for you? If you are an investor, you need to decide whether you want exposure to silver. And if you do, you need to think very carefully about how you get that exposure. Paper silver, such as futures contracts, ETFs that are not fully backed or unallocated accounts, carries counterparty risk. If the financial institution holding your paper silver goes bankrupt or cannot honor your request for delivery, you could lose everything. Physical silver in your own possession has no counterparty risk. It is yours. You can hold it, you can barter with it, you can sell it to a local coin shop. But physical silver also has storage costs, insurance costs, and the risk of theft, so you have to weigh those factors. Many people choose to allocate a small percentage of their portfolio, say 5 to 10%, to physical silver as a hedge against the scenarios we have discussed. If nothing happens, you still own a tangible asset that has maintained purchasing power for thousands of years. If something does happen, you will be very glad you have it. If you're not an investor, but you're just someone who wants to understand the world, this story matters because it affects the price of everything. Silver is used in almost every electronic device. When silver becomes expensive, phones become more expensive, cars become more expensive, solar panels become more expensive. That slows down the green energy transition. It makes inflation worse. It adds to the cost of living. So even if you never buy a single ounce of silver, the silver shortage will affect you. Governments and central banks are starting to take notice. The U.S. Geological Survey has added silver to its list of critical minerals. The European Union has done the same. China has been stockpiling silver for years, probably as a strategic reserve. But no one is talking about it openly because no one wants to panic the market. That is understandable. Panic makes things worse. But silence also has a cost. When the shortage finally becomes impossible to ignore, the price adjustment will be much more violent than if we had managed the transition gradually. Let us revisit that headline number from the beginning. Only 400 million ounces left. But we have since refined that number. After accounting for deficits in 2024 and projected deficits for early 2025, the real number might be closer to 300 million. And after subtracting all the silver that is already committed to ETFs, industrial safety stocks, and exchange minimums, the free silver might be under 100 million. Some of the most bearish analysts on the physical side say that the truly available silver, the metal that can be bought and taken delivery of tomorrow, is less than 50 million ounces. That is less than 2 weeks of global industrial consumption. 2 weeks. Think about that. The entire global economy is running on less than 2 weeks of silver inventory. One major supply disruption, one mine strike, one natural disaster that shuts down a primary silver mine, one geopolitical event that blocks shipping lanes, and the system could seize up. That is not fear-mongering. That is just the math. Macro Truth wants you to walk away from this video with a clear understanding of the numbers. Not opinions, not predictions, just the numbers. Total annual mine supply, 850 million ounces. Total annual recycling, 150 million ounces. Total annual industrial demand, 600 million and growing. Total annual jewelry and silverware demand, 200 million and stable. Total annual investment demand, highly variable, but historically around 100 to 200 million ounces. When you add it up, you see the deficit. The only way to avoid a deficit is for investment demand to turn negative, meaning investors sell more than they buy. But with inventories this low, why would any investor sell? They would be selling into a market that's about to run out. That does not make sense, so the deficits are baked in. They will continue until the price rises enough to choke off demand or bring in new supply. And because industrial demand is inelastic, the price may have to rise a lot, possibly more than most people can imagine. Before we wrap up, let me address a few common questions that people ask when they hear this argument. First, what about the billions of ounces of silver that are in the ground? Why can we not just mine it faster? The answer is time and money. Even if a company discovered a massive new silver deposit today, it would take at least 5 years to get it into production. Permitting, environmental studies, community consultations, financing, construction, and commissioning, that process cannot be rushed, especially in countries with strong environmental laws. And in countries with weak laws, there are other risks like corruption, political instability, and labor unrest. So new mines are not a solution for the immediate deficit. Second, what about the silver that is held in private hoards? There's a lot of silver in India, for example, held in family jewelry or religious idols. Could that come to market at high prices? Possibly. But much of that silver has sentimental or cultural value. It is not going to be melted down and sold for a mere $50 per ounce. It would take a much higher price to unlock those hoards. Third, what about the silver used in industrial products that could be recycled? That is already being recycled as much as economically feasible. The problem is that many products have long lifespans. A solar panel lasts 25 years. The silver in it is not available for recycling until the panel is decommissioned. So there is a lag. By the time those panels come back as scrap, we will have installed many more panels, increasing the deficit even further. So the bottom line is this: the silver shortage is real. It is driven by math, not by hype. The deficits are documented by industry sources that have no incentive to lie. The inventory drawdown is visible in the weekly reports from the COMEX and LBMA. The growing demand from solar and EVs is public information. And the inability of mining to respond quickly is a geological and regulatory reality. All of these factors point in one direction: higher silver prices and eventual physical scarcity. When that scarcity becomes acute, the consequences will ripple through the global economy. And the only people who will be prepared are those who understood the math before the media started talking about it. Now we want to hear from you. Do you think the silver market will experience a true physical squeeze in the next 2 years? Or do you believe that higher prices will bring enough supply to avoid a crisis? Let us know in the comments below. And do not forget to share this video with anyone who cares about investing, the green energy transition, or just understanding how the world really works. The more people who understand the math, the more prepared we all will be. This is Macro Truth signing off. If you found value in this breakdown, hit that like button and subscribe if you have not already. We put out deep dive analyses like this every week, covering the most important macroeconomic and commodity topics that the mainstream ignores. Stay curious, stay skeptical, and always follow the numbers. We will see you in the next video.